Welcome to our YouTube live. I'm a little bit croaky, so we'll do our best to get through this hour without my voice giving out, and for me not to laugh, because when I laugh, I cough. So I have to not laugh. So please don't make me laugh. And right, so first of all, let me just mention the podcast this week, because that was kind of interesting, because if you're not aware, Daniel Kahneman, the famous psychologist who also got a PhD who also got a Nobel Prize for economics, which is unusual for a psychologist. He passed away this week, so we did a kind of tribute to Daniel Kahneman on the podcast. So if you're not aware, our podcast is called the Many Happy Returns podcast. Here it is. Here's me and Michael Pugh, my co-host. And it's an interesting story about his life. I didn't realise he grew up in Nazi-occupied France and spent a lot of his life, his early life, avoiding being captured. And yet he went on to build this incredibly successful academic career in the US later on. But still, fascinating ideas he came up with. You're probably familiar with his book, Thinking Fast and Slow, about these two thought processes that we have, where we have heuristics that allow us to make rapid decisions, but often when it comes to investing, you want to make those kind of slow, well thought out decisions without jumping to some quick decision, which often results in a bad decision, certainly when it comes to investing. So I think, it has huge application to investors. He also wrote a more recent book about noise, where he's talking about how to make good decisions. So again, I think that applies to investing. So do check it out. So here's Michael. I should have not covered his face. Lemsip, very good. So let's start with a super chat, because if you do a super chat, we'll push your question to the front of the queue. And we've already had two in fact, one, and we've also had one question from one of our supporters on YouTube. We'll answer your questions first. Please do super chat, because obviously it helps us financially. Please do please do subscribe to our channel if you find our content helpful. So the first question, a super chat from Johnny Bristol, is, in your experience, how closely followed are AIM stocks by analysts, fund managers? Could there be any opportunities in mispricing, misunderstanding? I think if you're not familiar with the AIM market in the UK, it's the small cap market, and to list on AIM, it's slightly easier than listing on the FTSE, the standard exchanges in the UK, the London Stock Exchange, as part of the main index, because it's designed for small caps. There are certain, but these are small companies, right? So they tend to be less liquid. They tend to be more risky. Often they're not proven business models, but of course that's the beauty of investing in small caps, the beauty and the drawback, which is that these aren't proven companies, but they potentially got a lot of growth potential if they succeed. So a lot of people like fishing in AIM because they think they can spot opportunities there. And it is kind of interesting to look at the companies on offer. But if you look at the analyst coverage of AIM, generally analysts will cover stocks which can be bought by institutional investors. And if it's a smaller liquid stock, it probably won't have much coverage from the standard brokers on the street, because it's really not in their interest to do that. Remember how they get paid? They get paid by covering the stocks that fund managers want them to talk about. And they get voted for in broker surveys by pension funds and other fund managers who think their research is helpful. And if you're a retail investor, you don't get to vote for them in the surveys. So you don't really count in their world as an analyst if you can't vote for them. So I think they focus on these large cap stocks. So I think the AIM coverage is pretty thin. If you look at any of the small caps on AIM, you'll see that. If you look at the broker consensus, it won't be very extensive. Whereas if you look at something like Vodafone, there'll be several analysts from different investment banks which cover it. Does that mean that you've got more opportunity to generate returns above the market? Maybe. I just don't think that, firstly, the research helps in the first place. I don't think the researchers necessarily can spot a good stock, even though that is their job. They might think they do, but I don't think they generate outperformance. Because remember that when a broker, so let's say that you're an analyst working for Goldman Sachs, you publish a report about Vodafone, you're the telecoms analyst, you publish a report about Vodafone, everybody in the street and in public will get access to that information, that report, at precisely the same time. There are very strict legal rules from the regulators that market-moving, non-disclosed information has to be disclosed simultaneously to the entire market. Otherwise, it feels a little bit like insider trading. So there is no informational advantage that you can get from reading those reports. Everybody sees the same report. So even if it is insightful, it's not going to generate outperformance. So I think that's the first misconception. I don't think that the analysts necessarily generate outperformance because everybody sees the same stuff and they may not have that much insight in the first place. And then leading on to your question, does that mean that the ones which don't have a lot of research could outperform because they're not scrutinized so heavily? You might be able to spot a diamond in the rough because an analyst may have missed it. Maybe, it's possible, but I think it's unlikely. I mean, certainly I've been using Stockopedia, and that has a kind of scoring system for AIM stocks as well. Let me just show you what that looks like. So if we look at an AIM index, look at the AIM index in the UK, and should be able to find it here. Here we go. This is the AIM 100. So these are the largest AIM stocks, and I'll share this. Hopefully you can see that. So these are the AIM 100 stocks. So let's just choose one that's been doing well recently, because that's kind of exciting. Let's choose one that's been doing well over the last 3 months, like I don't know. Let's use Gamma Communications. So what you can do is look it up on Stockopedia. Gamma Communications. Here we go. And what this does is it creates a score for the stock based on its quality, value and momentum, and then it combines those three into one single stock rank, such that if it's a high number, it's a good stock. So I think these systems might let you find stocks which are good. I've got a filter so you can create these screens, they're called, for a small cap value momentum portfolio, where I use these criteria. The quality has to be greater than 50, the value rank has to be greater than 50, the momentum rank has to be greater than 50. Remember, those three factors are not conflicting. Value and growth are conflicting, but those three aren't. And then the market cap has to be greater than 100 million, less than 1 billion, and the bid offer spread, as I now know, has to be less than 500 basis points. Yeah, I won't tell you that story. Anyway, this is sorted by stock rank. So these are the best stocks, these are the worst stocks, and then I choose 2 from each sector, and I rebalance it once a year, probably. So I think, can you fish in this sector, in the AIM sector, using a filter like this, a screen as it's called on Stockopedia? Yeah, you can, and it's kind of fun, but it is fun portfolio stuff. In other words, I'm not convinced that you can outperform this way. You can try, and it's fun trying, and it teaches you about the stocks, it teaches you about your own limitations, but is it likely to outperform the market? I think it's unlikely. But yeah, it's not commonly bought by institutional managers. These companies are usually too small to be bought by $1 billion hedge fund. So yeah, maybe you'll find some opportunities there. And having said that, my portfolio is doing pretty well. At least it did until I rebalanced. because I didn't have that liquidity filter. And when I rebalanced, it immediately lost 10%. So all of my gain, which was 10%, literally went overnight. And so now I've got a new filter which ensures that the stocks aren't so illiquid that whenever you rebalance, it's just going to cross this huge bid offer spread and leak away all of your alpha, if alpha existed, which might be a figment of my imagination. So yeah, Johnny, I'd say have a go. And but if you are going to do that, if you are going to try and beat the market in small caps, just remember they're very volatile, they're very risky because they're early stage companies, and it's unlikely to work. So just size your bets accordingly. Don't go all in on that because it's a very risky strategy. 90% of my money's in a globally diversified stock fund, and that's why I'm not too scared to play around with 10% of my money in things like that, because I'm confident that the main part of my portfolio long term will do well, and I can screw up with the fun stuff. And incidentally, that was one of the things we talked about on the podcast, the idea of having a fund portfolio. A lot of the ideas I talk about are from Daniel Kahneman. So, he's a great source of inspiration, I think, when it comes to investing and how to think and how to plan your decision processes in a structured way. So, yeah, he'll be missed. Brilliant. So, next question is also it's from one of our supporters on YouTube, and it's from Minsk, who says, what do you think of fixed term savings accounts as an alternative to similar term government bonds? It sometimes seems like you can get better rates that way. Yeah, I just remember the tax benefit of single government bonds, which is that you don't pay capital gains. So if you choose them carefully, if you choose a low coupon government bond, you're not going to pay capital gains. So if you're holding the savings outside an ISA or a SIP, then a very tax efficient way to invest and safe way to invest is with single government bonds that you hold to maturity. Low coupon ones will have very little savings income which they generate. The coupon's treated as savings income, and so that's a very tax efficient way to save. Whereas you will pay capital gains, you will pay tax on the fixed term savings accounts because of course all of the gain is income, so they're not so tax efficient. So if you compare like for like, once you adjust for the tax rates, I think you'll find that the gilts are actually very favourable outside an ISA or a SIP. Inside an ISA or a SIP, there may be less of an advantage. But also at the moment, the situation is that we've got very little term premium. So the curve's not upward sloping, the gilt curve. So at the moment, it's not really very favourable to have more duration risk and to buy gilt. Whereas in the past it was, and in the future it will be again. So yeah, let's just have a quick look at the yield curve, just so you can see what I mean. These are the trackers that you get if you're a member of our community. The macroeconomic one has this tracker, which is the UK yield curve. So the shape of it you can see is quite weird at the moment. Normally you'd expect this to be upward sloping. So at the short end it would be at roughly 3%, and then it gradually slopes upwards to 5% for 50 years. Well, at the moment it's all inverted. So the short end has a higher yield than the long end. So you're not paid, you're not compensated to lock in rates for longer and take more duration risk. So that's very unusual. So when we go back to normal, the cash accounts will be earning 3%, 2% down here. And then the gilts will be earning increasing amounts of yield according to how long you lock in a fixed rate. Excuse me. So that's the usual situation. It's just weird at the moment. But to answer your question, which was what do you think of fixed term savings accounts as an alternative? Yeah, if you're comfortable with a fixed term savings account and you're happy locking in your money, another benefit of gilts, of course, is you can sell them in the secondary market before maturity. Of course, you're not guaranteed to lock in a yield to maturity then. You might take a loss, you might make a gain, but they are liquid. You can sell them. Whereas with a fixed term savings account, you're often locked in for some period of time, and there's a penalty if you sell it before that time. So that's another benefit of the choice of gilts rather than fixed term savings accounts. But you should always consider all of your options, and if you're happy with fixed term savings accounts and you can find a good one, and you're happy with the credit risk of the bank offering the savings account, then yeah, and it comes with the FSCS guarantee, of course, that's always worth checking, then yeah, why not compare that as well. But if you are going to be outside an ISA or SIPP, just make sure you take the tax into account. The next question is a super chat. Thank you from Rio Carl from Canada, I guess, because it's in Canadian dollars. So Rio says, Rio Carly, I think, always have this fear. Oh no, Rio Carl says, I always have this fear what will happen if I invest a lump sum amount and the bubble bursts and it falls down 50% and it takes 5 years to come back. Even drip feeding for a year and market fall at the end. Yeah, so if you're worried about markets falling, the statistics to remember are how long crashes have lasted in the past. And I'm going to look for a graph now while I talk at the same time, which is pretty impressive, I think. Global 100. And this is a graph which you may find interesting. Let's see if I can get it to work. So the really interesting stats are based on how crashy indices are. So the question is, how long on average do markets take to recover after a crash? And if it's a global index, what's interesting, and this didn't work, oh dear, library, let me just try something and then I'll try that again. Yeah, so if you go for a global index, it's less crashy than a single country index, because at the moment everyone's kind of obsessed with the US because it's performed so well. But even the US, if you just invest in one country, tends to be more crashy than investing in a global index. So what I did was I tried to find a long-term global index, and the best one I could find was the S&P Global 100, which I'm about to show you the stats for, if I can get this flipping graph working. Oh, here we go. Right, code on the run, that's what I call this. Right, and yes, so I'll put my face over there on the code. So here we have it. So this is the S&P Global 100. It's a market cap weighted index of the 100 largest companies in the world, and it's international. And what's interesting is if you look at this length of the crashes here, because the S&P had this awful 12-year period, almost 13 years, between 2000 and 2012-13, when it had the double crisis. It had the dot-com bubble, which was a US thing effectively, and the global financial crisis, which is again the US at the epicenter of the problem with the US subprime market in mortgages. Well, if you have a global index and you go back to 2007, yes, there was a crash, but the length of that crash, peak to trough, back to the peak, was only 2.2 years instead of 12 years. The size of the fall was only 35%. And that's the benefit of diversification. And then the next one, 2011 to 2012, it was only 1.5 years. So instead of two back-to-back crises where one just about recovered and then you got the other one, you've got two little dips rather than double massive dip So that's one of the benefits of diversification. So the reason why I'm showing you this is because of the stats. You can't really find a period going back for 20 years for this index when there would have been a long sustained drawdown and it didn't recover quickly. 2.2 years I could quite happily live with. So all I'd say is if you do go globally diversified, then you're less likely to have deep, long drawdowns, because however bad the problem is, it's unlikely to affect the entire world. The US is now so important, of course, that becomes more systemically important, but it's still the case that it is diversified. So even if it's 60% US, it's 40% not US. And so there's an opportunity to recover more quickly. So I think the rule I came up with when I was looking at the S&P was also quite reassuring. I called it the 2-6-16 rule, but the probability of a 30% or greater fall in the next year is only 2%. And yet so many people are terrified of that outcome. The probability of a 20% or greater fall is 6%, and for a 10% or greater fall is 16%. So, the really big ones, the 30% plus, only has a 2% chance of happening. And yet people base their whole asset allocation and their retirement plans on that probability because of its big impact, big negative impact. But I think having a globally diversified index is it isn't a cure against that big deep drawdown, but it is likely to mollify the depth and the duration of the drawdown. So I think if you're not comfortable with equity volatility, then don't take the risk. Have less equity in your portfolio. It's certainly not the case that 100% equity is suitable for everyone. But that's the route I'm going to be going down for the rest of my life, pretty much, except for the period just before and after retirement, when sequencing risk is much more important. So then I'll de-risk a bit, but not hugely. And then after that 5-year period into my retirement, I'm going to re-risk and go back to 100% equity until I die. That's the plan. But it's not for everyone. If you don't like the volatility, if you're going to lose sleep at night because you're worried about crashes, then clearly that's not a portfolio for you. And there is no one size bet which best fits everyone. You've got to find a portfolio you're comfortable with. And this is why I always say don't copy what I do, because it may not be appropriate for your risk appetite. So yeah, I think a lot of people are worried about that kind of scenario, Rio, as well as you. The drip feeding is more to get into the market and to build up your risky portfolio rather than avoiding this kind of drawdown. So that's what I consider. But there are certain points in your life when you can afford the risk. When you're young, when you've got a long investment horizon, if you don't need the money. A lot of people I speak to, they don't need the money because they've got a defined benefit pension, they've got a company paying them a high income, they've got a portfolio of buy-to-let properties that generate a good income, and then the investment money is just fun money really, so they can afford to take more risk with it. But if that's your bread and butter, if that's literally what you're going to be living off, you don't want to take a big risk necessarily. So really it depends on your circumstances. But I completely understand your fear of that, Rio, and that's something we all share. I don't like falls in my stock market portfolio, but you just have to be used to it, I guess, and prepare yourself for it. And also diversify away from stocks if you're not comfortable with it. The next question, nice little icon there from Gavin Lawrence. Thank you for your super chat, Gavin. He says, can you give your thoughts, opinions on QYLP? Funny you should mention that, Gavin, because I just bought some recently because I thought I'll never truly understand it unless I buy it. So let's see what QYLP is. So let's first of all look at QYLD, which is the US one, and then we'll talk about QYLP. So, often people ask me about this because it seems too good to be true. So what is it? So this is called a covered call fund. This one's created by Global X, that's the name of the asset manager. And what they do is pretty cool. They take the NASDAQ 100 index, and they sell the upside with call options. So you might be thinking, so I've got a stock index which is really exciting and has lots of growth potential, but I'm selling the upside. Why would I ever do that? Well, the reason why is if you sell an option to somebody else, what they give you on day one is money, and that money becomes an income. So if you're always selling 1 month call options on the NASDAQ, then every month you're going to have a steady stream of payments as you pay away the upside. The drawback is you keep all of the downside. So if the NASDAQ falls, the value of the fund falls. If the NASDAQ goes up, you don't participate in all of the upside because you've sold some of it to other people. But the benefit is that the NASDAQ is a very volatile index. And the more volatile an index, the more valuable the options if you sell them. And that means that the income on this fund is 12%. So its dividend yield is 12%. So it always seems pretty shocking when you look at it, and you always have to do a double take. So let's have a quick look at the expense ratio is high, 0.6, so the management fee is not tiny. But you can see it's got chunky assets, about $8 billion. But if we look at the yield on this thing, the trailing 12-month yield, it's 12%. So huge. Because the options are valuable. And that's why people want to buy the options that this fund is selling. So it loses the upside if there's a huge rally on the NASDAQ, but it always makes this income. And in fact, if there's a crash, you will take a hit with the value of the fund. I don't know if it's got a price history here. Yes, it does, maybe. It doesn't have a graph. Let's see if we can find a graph of the value of QYLD. Should be here on SharePad. QYLD. Yes, here we go. So nothing like the NASDAQ. If we overlay the NASDAQ index, QQQ, you'll see that we've given away the upside. So the NASDAQ's trundling up, 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 up. This thing doesn't, because they've sold the upside. They kept a little bit, because you can see it's creeping upwards over time, but not all of it. So that's why it's a problem. Now, we haven't seen a crash over this time period since 2022, since the fund has time series. But if we had a bit more history, you'd see that when the NASDAQ crashes, like in 2022, so would this thing. That means you can buy it at a high yield. But that's how this thing works. It sells the upside, turns it into income, and generates a high income. So if you imagine you're in retirement and you've got £100,000 to invest in an ISA, if you buy QYLP, which is the sterling version of QYLD, QYLP, yeah, here we go, it's a sterling version of that. So you can see this thing trades in sterling, and it trades on the London Stock Exchange. Let's see if we can find it on the LSE. Here we go, QYLP stock. So here it is, trades on the London Stock Exchange and trades in sterling. Let me try that again. And it pays an income, pays the income in dollars, it has to be said, and then it converts it into sterling in your brokerage account. And yeah, I mean, I bought it recently because I just wanted to see how it worked. It pays its income every month, so you'll get a 1/12 of 12%. And what I've done is I've bought it on Trading 212, so I've converted this income fund effectively into an accumulation fund, because I've made a pie with just one entry in it, which is this fund. And that means that whenever it pays a dividend, I automatically just buy another 1% of the fund. So it's as if I own more when it pays a dividend. So that's what I did recently. So that was kind of fun. And Laura's done it as well, so I helped her set up hers as well on Trading 212 in a pie. So that's kind of cool. You can convert an income fund into an accumulation fund effectively. And it sits in my ISA. And I just thought, you know, if you are in retirement and you use this as an income source, how safe would it be? And of course, the huge problem is that if there is a crash in the NASDAQ, you'll see a capital loss. Only if you sell it, of course. The other point is that you usually buy it when it's paying a high dividend yield. But it is fairly stable, the dividend yield on this thing, but it would be even higher if the price falls. So I think that's probably a better point at which to buy it. I bought it when the NASDAQ was riding high, and in retrospect that was a mistake. I should have waited until a crash and bought it then, but I just wanted to understand the fund. And I think I do understand it better now. But it pays every month. So I just checked the latest. Let's just get the dividend history. It's only paid a few dividends because it's only just been launched in the UK. Let's have a look at the financials and the dividends. I don't know if you can see that. Not yet. You can now. So these are the dividend payments. And there have only been 5 dividend payments. But if we look at the payment itself, it's about 17 cents. And that'll turn out to be about 1% of the value of the fund. So 1% a month, about 12% a year. So pretty chunky dividend. And 17 cents converts into about, I don't know, about 12 quid, I think, from memory. Anyway, that's, I like it. You know, I like it because it's a high dividend paying stock, a high dividend paying fund. And I just like the idea of the covered call. But it's not for everyone. You know, always, if you don't understand it, don't buy it. And just understand the drawbacks and the risks, because that's pretty chunky in this case. You've kept all of the downside of the fund itself. So just be aware of that. At the moment, you won't feel the pain because the NASDAQ's just trundling upwards. But if we looked at it in 2022, you'd see, yeah, there's a problem with it. There's a risk. And a lot of people, I think, would not be comfortable with that risk. If you imagine if you're in retirement and suddenly you see, you know, it falls 30%, 40%, which the NASDAQ often does, then clearly you wouldn't be too happy if you have a capital loss, on paper at least. Yeah, so I like it. Right, so I think that's all of the super chats. If you do have a super chat question, please do ask. At this point, I might summon my dog, and he's probably driving Laura mad downstairs because he hears my voice. He knows about YouTube lives, and we've worked out this is part of his strategy, which is he doesn't really like these treats, the buffalo ones. He likes the ones Laura gives him, but he knows that if he comes and gets one of these, he gets the biltong off Laura just after that. So here he comes. Thunder of paws up the stairs. Oh, hello, Ted. How are you doing? You haven't been whining, have you, for Laura? Yeah, you got the treat. You're going to go now. Why don't you show the people the treat you can do? The trick. You're going to stand. You do some very good standing, don't you? Going to stand. Come over here. In front of the camera. Oh, good boy. Oh. He's more coordinated than his father, clearly. You want one more? One more. Good boy. What's that? Can you hear Laura? She's got the biltong. She's got the biltong. Go on. You go and get the biltong with Laura. Yes. Very good. He's off. He loves that biltong. Oh dear. That's good for clearing the sinuses. Yeah. So anyway, that's Teddy's party trick for tonight. My voice is still holding out. If I hit the lemsip hard, I'll be fine. So please do like and subscribe. If you've got questions, please do a super chat. It helps us, obviously, if you do that. But I'll now answer some questions from non-members. Oh, there's a nice little heart from Lynn who says, "Evening, Laura, Ramin and Teddy." Thank you. Thank you, Lynn. And Johnny Bristol says, "What stock is the chart from the Many Happy Returns thumbnail based on? It looks like a buy." Yeah, the standard joke between Michael and I was that, let me share it. The standard joke was that since we launched the podcast, there was nothing but bad returns. But of course now it's turned positive. But at the time, it all seemed quite gloomy. At least we've had some happy returns at last. Back to your questions. Nova says, "Good evening." Good evening, Nova. There's a question from Kenny Fabled, who says, for those of us, hi Ramin, for those of us looking to move to an ETF with a lower expense ratio, what would be the best way of doing this? Say for moving from VWRP, that's the Vanguard Global FTSE All World tracker, to FWRG, which is the Invesco FTSE All World tracker. Well, I think on some platforms you can't have all. Yeah, there is a platform limitation, so it really depends on what platform you're on, how easy it is to switch, and whether you can switch, and what funds are available. So really, that's the primary determinant of switching. The other question is, are there trading fees? Sometimes there's a cost of switching. Is it in a general investment account, in which case you might realise a capital gain when you sell one fund and buy another? So there are all these considerations. Really, it depends on the circumstances. But if you are going to move to another ETF, if you're already in an ISA and there's a fund you're moving from to another one, there's no reason not to switch, because if it's on a low or no commission platform, then the actual switching cost, the transaction cost, is almost zero. There will be a bit off the spread, but for a liquid fund, it's unlikely to be big. And then the other consideration would be taxes, but in an ISA or a SIP, there aren't any, so that wouldn't be a worry. So, there's no reason not to switch, which I think is a good thing. That's great if you've got no reason not to switch. So just sell the thing you don't want and buy the thing you do. That's the easiest thing. Yeah, like the only reason you wouldn't do that is because of a tax reason or a transaction reason or a psychological reason, which is that you're scared to switch. I think that's often the case when I speak to people. If you're switching from a global fund to another global fund, the thing to remember is the risk is negligible, because what you're not doing is changing the actual allocation much at all, because you're changing from one thing to another thing which is very similar and has probably almost the identical set of stocks with slightly different weights. So that's why, switching from global funds to global funds is not a big deal. Switching from global funds to a bond fund, that is a big deal, because that's changing your asset allocation as well. And that's scary stuff, and it's changing the entire characteristics of your portfolio. So that would be a big change, and you'd have to think about that very hard, because that might not be what you want. But if it's just a matter of fees between two very similar funds, yeah, I just do it. That's what I do. Next question is, this is a good one. Srinivasan Palani, who says, "Good evening. Is it the right time investing in US stocks right now, or any other global markets? Thanks." Well, in terms of timing, yeah, the US is expensive now, and would I be piling into the US right now on its own? Probably not, because it is expensive. Other markets, very cheap. So Europe, cheap. UK, very cheap. That's why I bought the value, quality, momentum, small cap portfolio of stocks in the UK, because there wasn't a fund that would give me that. If there was, I probably would have just bought it in fund form. But that's why I bought it, because the UK is super cheap, and these are even cheaper stocks because it's got a value filter as well. So I think that's producing more upside. Because of course, if you buy when things are cheap, there is just by definition more upside. If you buy when it's expensive, you're overpaying for something. So I think at the moment, yeah, it's still the case that the euphoria in America is getting a little bit ahead of itself. Not crazily so, but a bit, certainly a bit. The thing to watch for is the FactSet Earnings Insight, written by John Butters every Friday, and the forward price to earnings graph is on page 33. Here we go. This is page 33, yeah. Move myself up here. That's still visible? Yes. There we go. So this is how many dollars people are willing to pay for every dollar of future profit. In 2020, they were willing to pay $23. In March 2020, they were willing to pay about $13. So it really depends on euphoria and greed, I'd say. At the moment, we're getting back into the greedy region when people are willing to pay quite a bit for the same dollar of profit. And it's not as bad as it was in 2020, at the height of the pandemania rally, but it's still pretty high. So I don't think I'd be piling into the US. There are much better, more reasonably priced markets right now. So Yardeni has a pretty good, let me just pull up the Yardeni graphs actually. They've just changed where everything is. So I always have a difficult time. So I've made a note of where everything is for just such an occasion. So I hope that's visible. Yep. So here it is. Emerging markets 12.1. So emerging markets are cheap. US isn't. 21.3. Is that right? 21.3. Yeah, it is right. 21.3. In emerging markets, of course, India is still expensive. Japan 15.5, UK 11.3, so pretty cheap. And Europe in general is quite cheap. I'm just trying to find India. There we go. So this is Europe. So France 14.6, Germany 12.3. Of course, they're going through a recession. That's usually a good time to buy, is when there's a recession, because nobody wants to buy the stocks. The markets are forward-looking, stocks and GDP's backward-looking. So the low point of a recession is usually a reasonable time to buy. Italy 9.3, Spain 10.7. Let's find India. Yeah, if you look at global and global ex-US, you can see the huge contrast. So all country ex-US looks pretty cheap. US, in contrast, looks not very cheap at all. But let's find India. Here we go. India, 22.4. So unlike the rest of EM, and China in particular, and Brazil as well, India's just on fire. And you know, everybody's buying stocks in India. You know, if it's your domestic market, I think you're kind of forced. You're not allowed to buy foreign stocks so easily. So you're forced to buy domestic stocks, and a lot of people are. And the economy's successful, you know, there's good GDP growth. So there's lots of reason to be optimistic about India. But, it's a big but, they've got very high valuations right now. So again, that's probably one I'd avoid. China, if you've got the courage and belief that they're not going to crash their own capital markets by doing something very unwise on the world stage, global geopolitically, then that looks like an opportunity. 9 times multiple. I'm not sure I'd do that. I wouldn't. Turkey also very cheap. It's a bit of a macroeconomic basket case with very high valuations, with very high inflation. So there the multiple is only 5 times. So there are opportunities out there, primarily in Europe, China, and Brazil looks cheap. But always it's the case that something's cheap for a reason. So it's always difficult to look through the initial problems or the current problems to see the future in which things are resolved, at least partially. Not everything's, it's never the case that everything's resolved, but the immediate problems get better. And in the case of China, my difficulty is seeing through to that point at which policy is more Western friendly. It just seems as if they're diverging from that path and moving very much into the sphere of influence of Russia and forming a bloc of politics, but also world power, which is separate from that of the West. And if that's the case, then there's a higher risk, I think, that they're going to be locked out of capital markets, like they were after the Chinese Revolution, when effectively the market went to zero and ceased to exist. So I think there is a risk of that, a material risk, which just is too high for me to get exposure there. But yeah, China's cheap. The UK, on the other hand, lovely market, reasonably priced, and I'm obviously talking my own book here, because I bought it. Brilliant. So I hope that answers your question. Oh, we've got some more questions from Super Chats now. Thank you. So MS Tech says, thank you MS Tech, Super Chat. Any thoughts on VWRP versus VAFTGAG? Oh, I'm not familiar with that one. Is this an April Fool's gag, I wonder? I don't know how Vanguard comes up with these semi-comedic names. Here we go. No, it's a FTSE Global All Cap. I used to have this one. So this one, it's sterling denominated, it's an accumulation fund, the fee is 0.23, and we're going to compare that with VWRP. So let's duplicate this tab, and we'll look for VWRP. Do we have a search, Vanguard? VWRP. So here's VWRP, and if we just contrast the two, this one is an ETF, this one is a fund. So if you're on Hargreaves Lansdown, for example, it'll be much more expensive to hold the fund version than the ETF version of this index. But these are slightly different indices which they're tracking. FTSE Global All Cap has a small tilt towards medium cap and small cap companies, whereas this fund includes emerging markets and doesn't have a tilt towards mid caps and small caps. So it's market cap weighted and it's global. This one, I think it's just developed. Let me just check the data. Portfolio data. Yeah, I can't see any EM here at all. So this one is just a developed market index. So it has no EM at all. This one has EM as well, although the exposure will be pretty small. Emerging markets 9%, so not huge, but significant, I'd say. So this one has no, oh, it does actually. Oh yeah, Global All Cap, it does have EM, apparently. About the same amount. So 9.4 versus 9.3. So pretty similar exposure, in other words. So both have EM. This one, the only difference really in that case is the market cap weighting. FTSE All Cap is slightly tilted towards small caps. This one isn't, and it's just market cap weighted. So if we flip between these two, hopefully we'll see the contrast. Maybe not. Yeah, I mean, you can see that medium caps, bit more here than there. Bit more medium, bit less, bit more, bit less. Similar to the small caps. Quite a bit more in terms of small cap exposure. So that's the only difference. And unfortunately, you know, the fees are going to probably be higher for the one which has the less liquid stocks in it, because the trading costs will be higher. Although there's not much difference actually, 0.23 and 0.22. All cap is slightly more expensive, but not very. But, you know, those are the primary differences. It's just the tilt to small caps. So if you think small caps are going to outperform, then yeah, I think the global all cap has a very small tilt to small caps. So yeah, that's why you buy it. And that's why I originally bought it, because small caps were cheap. But what I've done now is I've just got the global developed market fund, VHVG, in my core. And then in my fund portfolio, I bought the S&P 600 tracker, S&P 600 tracker, which is a US small cap tracker. And in the UK, I've built my own small cap index, well, small cap portfolio, because I think small caps in the UK could also be interesting. So those are the thoughts. You know, I don't own either of those anymore, but the fee's pretty high, 0.22, 0.23. And I switched to VHVG, which is a fee of 0.12, because I don't think the EM is going to outperform hugely. That's just my guess. But if you like EM and you want a global index, I think either of those would be fine. But there are cheaper versions of a global index out there. Next question is from Mal, who says, Super Chat, thank you Mal. How can an amateur investor invest in the UK market? I'm guessing that I guess you're based in the US, in the UK, Mal, because your super chat was denominated in sterling. In which case, you can buy a sterling. You can buy a fund which is based in the UK. So what are the choices? Well, the main indices in the UK are the FTSE 100, that's the large caps. The mid caps are the FTSE 250 companies, they tend to be more domestic, whereas the FTSE 100 tends to be more multinationals, which aren't really UK companies at all. About half of the revenue, I believe, comes from outside the UK. For the FTSE 250, the mid caps, I think more of the income comes from the UK. So it's more of a domestic index. And then you've got the FTSE small caps. And then the FTSE 350 is the FTSE 100 plus the FTSE 250 combined together. So those are the choices. And then the FTSE All Share includes the small caps. So those are the various types of index you can buy. And there are various trackers you can buy. So if you go to Just ETF, it's a pretty good source for finding funds that do a certain thing. So find stocks. Let's do the screener actually, that's pretty good. So we'll go for equity, country, UK, and then I just sort it by expense ratio. So here's a UK equity all cap, so that's large cap, mid cap, small cap, everything together. There's one from Amundi, very low fee, for mid cap and small caps. And yeah, so various choices, FTSE 100, those are the large caps. So as long as you understand which index you're tracking, I think that's the key thing to understand. But there are many choices of UK fund. And what's also kind of nice about the UK is it pays a high dividend, so 3.4% for these trackers often. FTSE 100 about 3.5, 3.8, depending on which one you go for. So it generates a pretty good income, but the capital growth has just been not very good historically. That's the drawback with the UK, of course. But it's looking cheap. You know, I like the UK at the moment. But single stocks, probably best to avoid, because you have to choose single stocks which outperform the benchmark, which is the UK index, and it's unlikely you're going to outperform. So I'd say probably avoid that. Next question is from Jar, who says, why did your linker not do as well as expected? Well, inflation didn't rise as much as I expected. It didn't stay as sticky as I expected. So if you look at RPI inflation over the life of my bond, it kind of tailed off. In America, I could have used the Fred database, but in the UK, it's not so easy. But certainly what happened, I expected inflation would kind of do this and carry on trundling up and then slowly tail off. But in fact, what happened was that inflation tailed off about halfway into the life of the bond and then basically flatlined. So I ended up earning about 4.9%, which was a little bit more than I would with a nominal bond. So I did get a bit of inflation uplift, but not as much as I expected. But, you know, I learnt a lot about inflation-linked bonds and how they're accounted for on trading systems. For a long time, there was £1,500 or £1,600 missing in my position because when it booked the trade on Interactive Investor, it didn't include the uplift. So I spent £5,000 to buy the bond. The day afterwards, 1,600 was missing because they pretend it hasn't got any kind of inflation uplift when they book the value of the bond. Only when it matured, on the day it matured, did the uplift kick back in, and I got my 5,000 plus back. So it was quite nerve-wracking initially until I understood how Interactive Investor worked. But I think it is confusing buying linkers. And I also think that the break-evens, understanding break-evens, knowing what the break-evens are, is quite tricky because you have to make a judgment call. Will inflation exceed the break-even that's baked into the bond? If not, then just buy a normal government bond. And usually the markets price in inflation pretty accurately. So your call, so when you're looking at the break-even, you're always thinking, yeah, it actually sounds quite reasonable, the level of inflation priced in. But, you know, when I bought it, I thought it wasn't reasonable. Turned out the market was right and I was wrong. So, you know, that's why I didn't make as much as I expected. And that's why I think, you know, I'd be cautious about buying linkers again in the future, because I'm not convinced I can call inflation, predict inflation better than markets can. And that's really what it's about. Do you have a better understanding of inflation dynamics than the market? And now I think the answer is probably no. But it is interesting, you know, if you do want inflation linkage, that's the way to get it, through one of these inflation linked bonds. Just understand break-evens if you're going to do it. Oh, it's a question for, oh, nice. Super chat from Amir Ketogchi. Always nice to see you, Amir. And he says, with the new tax year, WWYD, DCA or lump sum all in, what would you do, I guess? Dollar cost average or lump sum all in? And if dollar cost average, what intervals would you do it? Keep up the good work, Ramin. Thank you, Amir. I think at the moment, if I had a lump sum, I'd probably drip feed, simply because markets are looking a little bit frothy in the US. And when US markets look frothy, if they stop looking frothy, everyone usually pays the price. It's not just the US that sells off, it's everybody. So, you know, I'd probably drip feed at the moment, you know, at least until after the election, and then just see how things pan out after that. Because there is always the possibility that there's some kind of unpleasantness at the ballot box, or in accepting the result of the ballot box if it doesn't go the way certain people might expect it to. So there's always the risk of a sell-off if that happens. So yeah, I think that's probably a source of volatility and might cause a sell-off. Or it could be that inflation rises, because if we look at oil prices, those are trundling up again now, so there could be another energy shock. But yeah, I'd say that I'd drip feed, because I think markets are a little bit toppy at the moment. And what intervals would you do it? Probably a year. Certainly not 2 years again. Previously I did it over 2 years and it was too long. I'd say do it over 1 year. If there is a sell-off, accelerate it. But don't hold back if markets are falling, because that's a big mistake. And you almost certainly won't time it correctly. But if markets do tank, accelerate the drip feed. Buy more and buy it faster at a lower price. Adam Jenkins, another super chat. Thank you, Adam. He says, I have VUAG and looking at mutual funds versus ETF. What are your thoughts on passively managed mutual funds? Lots of info online about actively managed mutual funds, but not much about passive. Well, I mean, in the UK, what we call mutual funds, OEICs, certainly in a general investment account, because they're mostly domestically domiciled, if you go for an income version, they're much cleaner in terms of accounting when it comes to doing your self-assessment for your tax. So a lot of the pension grafters are really adamant. Pension crafters are adamant that you should buy an open-ended investment company, domestically domiciled, income, and that way there's a clean separation of income from capital gain, and it's just much easier to do your tax statement, your tax self-assessment. But passively managed mutual funds, you know, I'm completely indifferent as to whether I have a mutual fund, an OEIC, or whether I have an ETF. I don't trade intraday. I don't care if it's only got end of day pricing. That's the big difference between the two. An OEIC only has end of day pricing. An ETF has intraday pricing as the market changes because it trades on an exchange. But I don't really care about that because I very seldom trade anyway. If I was on a platform that charged more to hold mutual funds, OEICs, like Hargreaves, then clearly I'd choose ETFs because that's just the way the pricing works for holding things on Hargreaves. On Vanguard, which is a platform I've got, there's no difference at all in the holding fee, whether it's an OEIC or whether it's an ETF. So, you know, that's why I'm indifferent between the two. But, yeah, there are lots of passively managed OEICs in the UK, and I don't really mind which I own, ETF or OEIC, because I'm on Vanguard. Next question's from Luca Regenzani. Maybe that's an Italian name, not an Iranian name. I'm pronouncing it wrong. And he says, "Hello, Ramin. In one of your recent videos, you recommend the HSBC. I don't recommend the HSBC FTSE All World Index Class C accumulation sterling. I'm 32 and planning to invest for 20 plus years. Would that be a smart move?" Well, yeah, because it's a cheap fund and it's global, and the fee is 0.12%, which is very low. And a lot of the global funds, there's so much competition between them now. They're all the same because there's only one world to choose from. So the stocks in a global fund from provider A will be very similar to the stocks from global fund from provider B. So very similar holdings for slightly different fee. So you'd go for the one which is cheaper probably, unless you think the fund manager is incompetent. I mean, that's very unusual nowadays. So I think that's quite a reasonable choice. But of course, there are other indices to choose from. Of course, the one you're talking about, the HSBC FTSE All World Index Class C fund, is a fund. It's a mutual fund. It's an OEIC, an open-ended investment company. So on Hargreaves, it's expensive to hold. So if you are on Hargreaves, then I'd go for an ETF like FWRG, which gives FTSE All World, which is a FTSE All World tracker for a slightly higher fee of 0.15%, but it's an ETF, which is much cheaper to hold on Hargreaves. So it really depends on your platform as well. But if you are going global and you're going to be investing for 2 decades or more, then including emerging markets probably makes sense as well, just in case it does outperform. You're going to get that 7% EM exposure, which potentially could add a little bit of extra outperformance long term. For me, I've got a shorter investment horizon, so probably, the EM thing I'm not too worried about, so I'm sticking to DM. But the fees usually are smaller for DM, but not in that case. That fund is as cheap as my developed market fund on Vanguard, VHVG. So if I had the choice, I'd go for that HSBC fund because it's global, the fees are the same, and that's all I want, something globally diversified. So I think that's a reasonable choice. And probably over your lifetime, Luca, the fees will come down and there'll be new products which are even cheaper. So, just don't be kind of wedded to one fund. Be willing to be flexible and switch to another fund if it gets cheaper. Maybe that fund will lower its fees because it's a very popular one. And that's great if it happens. But look, we're well over time. We're 6 minutes past. Laura's going to come up with the Fozzie Bear stick and pull me off the stage at some point. So thank you all for the questions you've asked. Thanks for being a great audience. Always get great questions. Don't deserve an audience like that, but I appreciate it nonetheless. Please do like and subscribe. Please do listen to our podcast, Many Happy Returns, between with me and my podcast co-host, Michael Pugh. Better remember, Michael Pugh, my podcast co-host. And thank you for supporting us. Thank you for watching our content, and do consider joining our membership if you want to learn more about investing. You can find out more about that. Just go to our website, PensionCraft.com, or you can do one-to-one coaching with me like this, except it's just you and me. And again, you can find out more about that on our website, PensionCraft.com/coaching. And there's one more question. Okay, Vinay Raja, who says, how would you have split the investments when there's over 15k of cash lying in Vanguard accumulation, if not S&P 500? I've invested 2,000 in S&P 500. Well, I wouldn't go for US. I'd go for global. So I think the US at the moment is quite expensive and probably will underperform as a result. So I specifically wouldn't go for the US. I'd go for a global index, or even, dial back the US a little bit, or go for a value style of investing, which will tilt away from the US because it's relatively expensive, or the wrong bits of the US, which are quite expensive. But I don't do that. I just have one global fund, as you know, in my personal investments. But I'm not sure I understand. If not S&P 500. So you're saying, what would you do if you're not investing in the S&P 500? Yeah, I'd just go global. But look, it's so easy and cheap now to switch investments. Most of the platforms are now commission free. So I think the cost of switching is negligible, unless you've got a capital gain to declare. So I think, I just go global instead of US. I hope that answers your question, Vinay. But thank you for the super chat. I appreciate it. And look, thank you all for joining us. We'll be here again in future. We tend to space these a couple of weeks apart. And please do join us again next time. Do join our community, like, share, subscribe, and we'll speak again in the near future.